equities seem to not care. Sure, they're a little bit weaker today, but as this bond market's been whipsawed around, as the front end of the curve goes above 507%, equities have been higher for 9 out of the past 10 sessions. What is it going to take to actually care, to click in this idea that if we're pricing in rate cuts, it's bad for the equity market?
Right. I think we're going to have to actually see a recession, Danny, because when you look at things, consumer confidence is still remarkably robust. Retail sales is pretty resilient. So until we see a rollover in confidence, which is a leading indicator for consumption, think about it. Consumer discretionary, you're not going to change your habits of consumption if you still have a job or if you're getting wage increases. Even if they're not equivalent or higher than inflation, you're still going to maintain your habits of consumption. What fundamentally could change that, I think, is threats to your job security. So until we see some rollover more meaningful than what we've seen in the labor market, that's when I think that the market is going to realize that equities are going to have a tough time sustaining themselves in a stagflationary or recessionary environment next year. That's why I prefer fixed income over equities going into next year. And the fact is, equity risk premium in the US, in Europe, maybe only in Japan, but US and Europe just looks honestly atrocious. So I don't see why you would want to take risk at current levels, adding to positions that have done so well year to date, particularly the ones that historically underperform in recessionary or stagflationary environments. And that's tech, that's discretionary, that's communication services.
Well, and to your point about you preferring fixed income to equities going into next year, how much risk, though, do you see in that call to be longer in duration in the bond market, considering we have seen such volatility in the bond market that it seems like it's just very unclear what direction things are going to go. And we're moving this number of basis points with this degree of frequency pretty much every week.
Right. That's a good point. I think you still want to stay in short duration paper. It's still yielding very juicy levels, equal to, or in some cases better than earnings yield on the S&P 500. But certainly, I think in this fourth quarter, especially as we go into recession or look like we're going to, it's going to be time to find some duration in those higher quality investment grade names. I'm not talking about high yield. In fact, I would be recommending buying CDS on high yield. We haven't seen the credit cycle fully develop yet. I don't think that this is a whole new reality. What we've experienced, Kylie, from my perspective, is an aberration. It's not an entirely new economic scenario. So I think that recession and the credit cycle has been postponed. It's not been altogether avoided.
Yeah, you and UBS saying we don't see why things would be different this time. Kathryn, I'm afraid that's all we have time for. Thanks so much for joining us.